Hello and welcome to Simply Tax. It pretty much goes without saying that about 6 months in, we all continue to confront challenges related to the disruptions, both inside and outside of the office, caused by the SARS-CoV-2 virus and the incidence of COVID-19. So far on the podcast, we've covered many aspects of this impact in our COVID-19 response series that's comprised of episodes 90 through 95, 103, and 107 of the podcast, which you can listen to on our YouTube channel under playlists. So far in the series, we've talked working from home with Tony Nitti, covered the practical considerations of the Paycheck Protection Program and the CARES Act relief provisions, discussed managing risk with Kim Hirsch of Fusion Risk Management, covered evaluating business interruption claims with Will Weltman and Kevin Dreher of Reed Smith, along with BKD's Brian Callahan and Bob Sprague, and broke down what it all means at the state and local level with BKD's Mary Reiser and Jana Gradeva. On the podcast today, we take a look at how the pandemic is impacting financial statement audits and check back in on the role analytics can play in helping organizations with managing their cash flow and forecasts. I'm joined today by Megan Stern, an audit director in BKD's Chicago practice, along with Greg Knight, a director in BKD's analytics group we first heard from in episode 93 of the podcast on how he's been helping clients analyze how they make their money, don't make their money, and pivot in times like the current environment. Let's jump in and pick up where we left off when we last spoke to Greg.
Damien, I think when we spoke previously, we were reminiscing back to 2010 with the Great Recession and really the focus on cash flow and those kind of needs, seeing where it's going to go. I think since that conversation from there, the conversation has focused quite a bit on cash flow, the immediate need. And that's really where a lot of the conversations have been. Obviously, the whispers in the finance communities about all the loans that are out there, what's coming next, what does it look like on the banking side of the world. You hear lots of positive things from that they're managing their cash flow, they're in good shape, all the way down to some of them are just struggling simply because of the industries that they're in, that supply chain issues, a number of things that, kind of run the gamut of who's doing well and who's not doing well. But that's been the concern is really the day-to-day, the labor issues, trying to get back up and try to figure out what the new normal looks like. And that's really where I think the conversations are going to be for the near term, at least, on how do we just survive, not just today, but how do we pivot and what does the new world order look like?
Yeah, and you mentioned industry and obviously I would even say probably geography probably right plays a role in kind of how things have been playing out and in the restrictions and the caseload and all that sort of thing. But are there any other characteristics maybe that come to mind that your indicators of how people have fared during this in terms of their wrapping their arms around and maybe responding to some of the cash flow challenges?
Certainly, the industry plays a big part of it. Like if you're in that hospitality, the entertainment side of it, you certainly will feel the issues there, just because of what people are doing. Like if you're not going out to eat, you're not going to these places that entertainment or companies that supply into that, you're going to have that. On the same hand, I've heard construction is doing well. Now maybe that might change depending on what happens, but it really gets down to I think how healthy the companies are kind of coming into this. Were they positioned well? Did they really focus on a conservative approach and how do they control their spend, and the organization, were they looking at it versus some of the companies that maybe are just year to year type people? They look out 6 months to maybe a year, and it's like they might have been doing well in that environment, but then when you throw a situation in that's unpredictable, how does that affect these type of companies where it's like, okay, now I don't know what it looks like, but I have to change the way that I'm doing things just because it's been so disruptive to it. So while it runs the gamut, I think if you were healthy before and you were managed well and you had good systems in place to control that, you might do well through this process or manage through the process a little bit better than people who weren't quite as prepared for something like this.
So, Megan, kind of turning to your experience in all of this, and obviously there's been changes just in terms of even being able to work face to face. And well, that's just the tip of the iceberg, really, right? But a little bit different than probably your typical summer. But what's the experience been like, and how's that changed in this environment?
Sure. I mean, there are difficulties in not being face to face with your clients, besides just that human interaction, be able to kind of read people right when you're in their presence. That's been probably the greatest challenge. But fortunately, we have a lot of technology that affords us to do face to face meetings. Maybe second best thing is Zoom or go to meetings that we've been able to kind of use in the interim, at least until we can get back out to our clients. Fortunately, we can do a lot of things remotely. We can request a lot of files. We have secure portals that we're transmitting. We have to pivot, right? And think about how can we do things more efficiently, effectively, timely, and how do we communicate, right? So I know Greg talked about, kind of pivoting business. We have to kind of do the same and get creative and really plan out our audits with that consideration in mind. What if we can't actually physically see something? Well, is there another test we can do? Can we look at things a different way? So it's been a challenge, but I think it's good. It's an exercise and really thinking things through and kind of thinking at things differently and kind of rolling with the punches here.
Yeah, it's almost the only thing that you can do anymore is, like you said, roll with the punches and kind of we're making some changes on the fly. And I guess maybe speaking to that, and I'm the tax guy over here, right? So, but we do from time to time talk to the businesses and the business owners about how the audit's going and so forth. And the general question I've been getting is, what do I need to know and what's different? So, are there any special considerations in this environment that CFOs and those getting ready for audits should be focused on?
So I will say, specific to kind of the risks and uncertainties and going concern, guidance has not changed, but the environment has drastically changed. So, we alluded back to the recession 10, 12 years ago, kind of thinking in kind of those terms of, okay, management has to give an assessment of going concern. And now when we're having to adjust and, we have profit losses, liquidity issues, significant layoffs, compensation reductions. Those are red flags as an auditor, right? That's telling me that something's going on in the business that we're going to need to adjust. And those should be concerns operationally too. So not just for audit purposes, but for operational purposes. These are really important things to kind of to plan for and to get your arms around for. They say fail to plan, plan to fail. So to kind of project out that year out, that 2 years out, run some scenarios to see if the company is going to be able to meet future obligations. And I know that's really hard, especially in some different industries, because like Greg had mentioned, the entertainment industry, we don't know when are we going to go back to a live concert. No one knows, right? So these things are kind of hard to project, but we have to use the information at hand, what we know, and create kind of an assessment.
I guess, Greg, that's kind of your specialty, right? Dealing with what we do know, the data.
Yeah.
What would you kind of add to that in suggestions or tools maybe for actually doing that analysis and assessment?
It's interesting, like pre-pandemic, in the world that I've been living in around the consulting and growth strategies, and we've been talking about a lot of these same tools and scenarios. And there are companies you see out there that are doing a lot of elements of this stuff, good stuff. Then you see some of those companies that good companies, but they might not be doing too much of it. It's just not the focus. And what's important, even though it might be a challenge to do it right now, just because there's so much going on in the day to day here and looking out what's the critical activity that needs to be done is force yourself to do forecasting, cash flow modeling, scenario planning. All those are good things that will help their auditors through this process at the same time. It's things that we look at. Analytics are a huge component of audits, and it's those kind of tools there. It's like, and they don't have to be robust systems and complex tools that you got to go out and buy and learn. We can do a lot of this stuff in Excel. I mean, you can create that, you can think through this kind of stuff in those processes. So, but it takes some time, it takes some effort to really look into it, some guidance to really understand how to look at the company in maybe a slightly different way. How do you create good projection tools that can be used, can be updated on a weekly basis? As you go through this process, the important thing is to incorporate that knowledge, those things that you learn, into your culture going forward. As times continue to improve and things stabilize at some degree, which I believe they probably will at some point, is to keep that momentum going. Assume that this could happen again, maybe not necessarily with a virus, but there could be another recession, some kind of economic recession down the road. How do you prepare for that? And it really gets back to goal planning and thinking through those things of, where is the company going? What do I need to do with the company? How do I get there? What systems and processes and people do I need to eventually put in place? Create that plan that is quite detailed, but yet also, highly visible to the organization and the people who are helping execute that plan. So the analytics and the information kind of tells you where to focus on, and then it becomes to the execution of that too. So I'm obviously a huge proponent of the analytics. I think it can be used in a number of different ways, and it's not the end all, but it does help identify, much like we're all looking at all the virus statistics every day of how many cases there are, what's the positivity rate. It gives you an indicator of what's happening. And those similar things could be set up inside many companies very simply. That gives you the indicators of where the company's at. How do I pivot when I need to pivot? Can I see it before something becomes too far down the path where I can't make change? It's too late to do it without hurting the company.
Megan, I guess obviously going concern, that's kind of first and foremost, but it sounds like that's basically what you're saying is you got to remember what you already knew, maybe not necessarily anything new. Any other changes maybe that we have seen that would, I guess, come into play from an audit consideration perspective?
We're going to look at things like market decline and investments as well. There's going to be added disclosures and just added scrutiny. But besides, just going concern too, is taking a look at like that underlying information that you're using to have your projection. So I kind of wanted to mention that as well. Is you have to really have a base, right? Because you can make a projection, but is it reasonable, right? That's very subjective. Again, you really need to take a look at, okay, well, how reasonable is this? If we factor in, sales are going to be down 3%, what if we can have them be flat? What kind of costs do we need to cut? Kind of run some multiple scenarios, and you can substantiate your basically guesstimates, right, of what's going to happen. That gives your auditor a really good feel, and it should give you as a business owner, as a CFO, as a controller, a really good feel of, okay, I think I have a really good handle of operationally where we're going to be at a year out, 18 months out, 2 years out, to kind of project, and then you can roll with those punches a little bit better.
Another topic kind of underneath that in umbrella and getting ready, I know revenue recognition and the standard there was something that was, we'll say, new for this year, or I guess was it last year? Now I'm getting my years all mixed up, Megan. Maybe you can help me with the implementation date of the standard, but how is that coming into play now with audits?
It was new. Public companies adopted in 2018. Private companies were to implement for annual filers the year ended December 31st, 2019. If you have not yet released your financial statements, that date has been changed for implementation to extend for another year due to the COVID circumstances. In addition to revenue recognition, the lease standard ASC 842 was extended once again for those who haven't implemented till December 31st, 2022 for those annual filers. That would be the applicable year implementation is required. Now, early adoption, you can still early adopt. So if you have gone through kind of that process already, but you're kind of held up in kind of reviews or trying to figure out going concern issues, you can still early adopt to kind of get ahead of that curve as well.
I'm a tax guy, right? And so there's definitely some nuance there. And perhaps could you kind of give at least a little bit of what it is and what the key points are, maybe for those that haven't fully adopted it or are like myself and are coming from the tax perspective?
Of course. So revenue recognition standard ASC 606 came out, and basically it was to simplify the standard. Now, simplification means hundreds and hundreds of pages that were released to kind of provide guidance. But basically, it was kind of to be congruent with international standards. There are some differences between international standards and U.S. GAAP in revenue recognition, but it helps with the conversions of that. But instead of looking at, revenue as recognized when earned, that was under ASC 605, the previous standards. It's when performance obligations are met. So that can mean various different things depending on what type of revenue channels you have. We saw a lot of construction or manufacturers with long-term contracts, or even technology companies with long-term contracts that are probably more affected than others, rather than a kind of simple ship and bill model. There are various nuances, obviously, to the revenue recognition standard. There's a 5-step model that you kind of have to go through and do the exercise and kind of think about your revenue channels to go through. But the basic concept is that revenue should be recognized when your performance obligation is met. So when your obligation is fulfilled rather than at some arbitrary time.
I had some questions about this whole revenue recognition concept, and I'll bet that you do as well. So I had a separate conversation with Megan to get them answered. First up, what exactly is a contract?
People think of contract, right? And they think of something that's long-term or something that's big and extensive, but a contract can be as simple as an invoice. So that's really something that you have to think about it. So it's any sort of binding. It could be a verbal contract that you have with a customer, and it's going in and kind of analyzing those individual contracts and looking at those terms to see when revenue should be recognized based on those individual contract terms. So as you can see, that things could get really complicated depending on how many different types of contracts you have.
Okay, and who exactly does it apply to again?
Anybody who has GAAP basis financial statements, so generally accepted accounting principles in the United States. Now, if you're a tax basis, income tax basis, this is not going to apply to you. If you have a compilation or even a review that is income tax basis, the standard doesn't apply.
All right, I guess identifying a contract seems straightforward enough, but what are some of the challenges?
I would say making sure that we know the terms of the contract, right? So if you have a right to terminate, can you collect money on that contract if it goes awry, right? So if they stop the contract, they stop building this piece of equipment, is there a right to payment? That's one thing to consider. So that would be a first holdup in that. But I would say probably we're spending a little bit more time after we kind of identify those contracts, getting into that nitty gritty and kind of going in deep diving on the terms of the contract, right? So we know we have a contract, but what are the nuances within the contracts? And how different are contract to contract to contract? Do you have one master kind of contract for all of your customers, or do each differ? And when each differ and things are very specialized, and then if you even complicate it further and have them be long-term with multiple obligations within that contract, that's when things get complicated.
Contract. Got it. So what's the next step?
So first we identify that contract, and then second, they say identify the performance obligation. So I think really simplistically is like, what are you supposed to do? What are the terms in those complicated situations? You have something that you have to sell, right? You have an actual physical product. And then maybe you have a service piece as well. Well, those would be really two separate performance obligations. So you have to sell the product, and then you have that service that you have to perform afterwards.
Step 1, identify the contract. Step 2, identify the performance obligations.
Then we determine the transaction price, which sounds really easy, right? Sometimes it can be difficult. So we were talking about a little bit about software. What if they have a free upgrade? Like what I tell my kids, like nothing is free, right? You flush the toilet, it actually costs money. You have to allocate and I think I'll be jumping a step ahead, is that's the next thing, is to allocate that transaction price, right? Allocate the price to that. So you have to really think about, do we sell this separately? Or if we don't, there's guidance around acceptable methods to how to allocate that price. So it can be difficult, or if there's one line item for everything you sell and you have multiple performance obligations, it can get a little difficult. But there is guidance of what is acceptable.
Okay, I think I recognize what the steps of ASC 606 are now. Step 1, identify the contract. Step 2, identify the performance obligations. Step 3, determine the transaction price. Step 4, allocate the prices to the performance obligations. And I guess that just leaves us with step 5, actually recognizing the revenue. I mean, maybe I should switch over to audit, right, Megan? Okay, yeah, I'll stick with tax. So what's the biggest challenge in implementing ASC 606?
I think sometimes just getting down to that information. What I've noticed with my clients, the sales department and the accounting department sometimes are a bit disjointed. Salespeople are making concessions, doing all these discounts, all these things that would affect the contract. And then accounting gets it at the end, and then they're having to kind of fix that mess like we talked about before. So when it's a collaborative arrangement, that I've seen that be more successful with clients, or getting ahead of those types of things.
What's the key takeaway and best practice?
Like some of the key takeaways I would say is really, each contract is different. And I know we can get in the weeds and we can go through it, but those basic principles for clarity, you can slice and dice hairs on some of the guidance, and it's difficult, but I think really going through your contracts and formulating a revenue recognition policy internally is incredibly important and very powerful, because then you have something that you can rely on, right? You have that revenue recognition policy internally. So okay, when this type of transaction comes up, this is how we're handling it. Yeah. Other than that, you just have to dive in. You have to dive in. You have to really understand what's going on. Key is to communicate and make sure you understand those sales contracts.
Okay, one last question. Is it really worth it to go through all of that revenue recognition work and analysis if at the end of the day, nothing really changes? I mean, is it even really helpful?
I think that is helpful. And I think going through that together and sharing that and kind of making sure they're understanding the process. And I think what I've noticed too is maybe the president of the company or the CFO of the company knows a ton, but the controller doesn't know as much. So we're bringing in the controller into these conversations, and now they're recognizing when these things are happening.
I guess you could say that I recognized a good opportunity to dig a little bit deeper here with Megan, and I just couldn't pass on the adjustment given the materiality. Now, before we get back to my conversation with Megan and Greg, I wanted to quickly highlight that we've covered a lot of ground so far, and we have a lot more ground to cover, no doubt. But overall, we're really just scratching the surface here today, particularly when it comes to the audit and accounting considerations in light of the current situation that pretty much touch every aspect of the financial statements, whether that be investments, receivables, or inventory, or even my favorite, income taxes. That being the case, there's going to be a lot more that you'll need to evaluate, and likely many more questions coming from the audit team this year, and you'll want to be prepared for them. Please reach out to Megan and Greg with your questions and to learn more about how you can get ready. You can find their contact information in the show notes of this episode, available at bkd.com/simplytax. Let's go ahead and pick back up on revenue recognition and talk about it in light of the current situation with Megan. So I guess in light of, the situation that we're in now, and that, maybe a lot of, and we were actually talking about this on a previous episode here about business interruption claims and things like that, that there have been interruptions and maybe there are challenges with contracts and things like that. But any considerations or thoughts there, just the way that the delays here maybe have impacted things?
The delay could impact things, either positively or negatively. I think it's a really good idea to just take a look at it. I know that's just one more thing on everybody's plate, right? Everybody seems to be drinking from a fire hose with all of this information that's coming out. But if we implement ASC 606 and there's a change in revenue recognition and it's a positive change for you, if it could help you, you may want to implement. Now, is there probably some cost to implementing? Of course, there's going to be some cost. There's going to be documentation, really getting a plan on what your new revenue recognition policy is, and kind of going through, if you are under audit or review, that there are some additional steps that need to be looked at by your auditors. But it might be beneficial to the users of the financial statements to really know that impact. So it's a consideration. But on the converse, if that's just not something that you're ready to do or prepared to do, or haven't really had the time to get your hands around your revenue streams, and if there's something that's pretty complicated, the delay can be a benefit of to kind of punt that down the road. Now, I wouldn't say forget about it for the whole year. That's something you're going to have to pick up at some point in time, but definitely a conversation with your advisor might be helpful to kind of just think it out and plan it through to see if you would want to execute in implementing the standard or not at this time.
Greg, at the beginning, you were kind of talking about where we left off as we were kind of coming in, looking backwards a little bit, trying to get some insights from the Great Recession that we had in 08, 09. And you talked a lot about the power of the budget and managing the data and so forth. Anything else that maybe you would add to that at this point in time, or other tips or tricks that you would kind of sprinkle in now that we've been living with it for a few months now?
I think the key has been cash flow management. As I think back before all this happened, it's like I know companies do certain methods for cash management, and that I think what's become the focal point is predominantly how the banks look at what that cash flow is going to be. So 13-week cash flow forecasts, how do you roll that forward? And I think as certain companies enter into forbearance agreements or their debt obligations get delayed from certain payments. I've been on other various webinars where the banks are requiring that cash flow forecast to be put out there as a way to make sure, because I know banks, as time goes by here, and depending on if the situation gets better or worse, that debt obligation's still out there, and the banks are going to want to start knowing more and more about what's going on. And I know there's been a lot of good communication with the clients, which from the company to the banks, and I will continue to encourage that. If they're not asking you to do cash flow projections, I would certainly put that on your radar. I think it's a good business practice, even if you're a healthy company. I think it's a way to be, share that visibility with your banks so they can see what's happening with that. And I think that is just taking a proactive approach. So if everything is still feeling reactive, I would try to step back and think, it's like, how do I make this more proactive? What do I need to do to get there? And I think that's where companies should lean on their advisors a little bit for guidance if they're not utilizing those resources. There's a lot of experience that has been through multiple recessions, not just back in 2010, but even in the early 2000s. And so they've been down this path before a little bit from that perspective. And I think those are some similar concepts that were relevant then, they're relevant today, just going forward. So proactivity, clear communication, and then really just focusing on the issues. And it's I know it can be a challenge to put together a forecast against something that isn't so clear, but I think that's where scenario planning can come in. I think Megan talked about that a little bit here. Do high, low, medium, somewhere in between, where it's going. And it really gets to communication, not just with the banks, but the supply chain itself, the customers. What are your vendors doing? If there's nobody dedicated to something like that, maybe focus on that, because that's going to be where you can start translating that information into, what is it going to start telling you? So if your crystal ball is not very clear, what can you do to make it a little bit more clear? Megan, I don't know if maybe that's something that you're seeing as well too, from the communication of the banks to your clients, but it seems to be the topic is all about cash flow and planning.
I completely agree. I think that's the biggest topic. I think cash is king, right? Our duty as auditors is to the bank, right? So we have to, assess for going concern annually. And usually that's not a giant conversation if you have positive cash flows and there hasn't been a catastrophic event, right? But we really have to look that date of our report release out to 1 year, knowing what we know on that date to project out. Management has to project out, and we have to assess those underlying assumptions to make sure that basically that cash flow to stay open and you can meet your debt within that year. So those are super important conversations to have. And I've had a lot of conversations where the client, asks us to be on the phone with the bank. And I think the bank really appreciates that third party in there because, we have to be independent as auditors, kind of talking through some of the challenges. You don't want to surprise your bank with, oh, well, we're not doing so well at the last minute right before. If you're consistently not making covenants and it becomes surprises. It's kind of like your kids, right? If they make a mistake and they come and they tell you, right? Or they do something wrong, or there's something bad that happened. You want them to come to you. You don't want to find it out in a different way. You kind of feel betrayed. And I think it's very much that kind of a relationship with the bank. You want to get ahead of it. You don't want to seem like there's anything to hide in that situation, because I think that decreases that trust and lending, especially during an uncertain time.
So, Greg, we talked a little bit about kind of how people are, maybe differently impacted depending on, again, industry or area or so forth. And you offered some tips already. Anything else you kind of add to the conversation as to kind of really what extra amounts of juice can you get out of your data right now? What additional insights can you get out of your data right now by implementing some of the Excel type tools that you were talking about?
I think especially as we evaluate companies ourselves, and we've been doing it for a long time, it gets back to understanding your cost structure. Very simply, it's like if you're a manufacturer, it's like, what's your material content look like? What does your labor content look like? What's your fixed spend to look like? So think of it in variable versus fixed, direct cost versus not. Don't just get hung up on that big bucket of cost of goods sold or services sold. There's a lot of different cost types that flow through that. And so I always encourage people to step back of it and think of it in a more simple term. How much material does it take to go into your products? What's the labor requirement, not just for the folks who make your products, but for the people who manage it, and then that organization level personnel, the SG&A labor that goes into it. Break it down, understand what's driving those activities. So it might sound a little bit like the ABC costing, and that's an element of what it is. It could probably be a little bit simpler and higher level than that. But if you start to understand those breakpoints, we like to call it that contribution margin. It's the variable margin that's there to cover the fixed cost structure. If you can start to isolate out which products have high revenue, high contribution margin versus those companies that are kind of there on that line, you might sell a lot of it, but it doesn't produce a contribution margin. It takes a lot more of it to get that similar cash flow. Then if you can isolate that out, look at it from that perspective, then it gives you the ability to put together a plan. These products consume too much of my time and resource. I need to shift resources here. I need to focus my customers there, my sales folks, to push more of this product out there. Maybe I shift inventories around to execute that there. So it really just highlights where you can focus your energy and your efforts if there's only so much of it, or the market has taken you in a direction where you have to pivot it that way. It just guides you along a plan. So I encourage you to not just look at it at a financial statement level. Look at those SKUs, look at those customers, dig into it a little bit, and see if you can break it down that way. And that's how we analyze our clients when we go in to do cost or profit studies on what's going on. We start to understand, okay, what does it take to make this product? What are the different cost elements that goes into it? Okay, is this all the variable stuff that we know about? Is everything else that's fixed, meaning it doesn't matter whether I make more or less of this, I still have to spend the same amount of money on this? How do you start to use that to your advantage to say, okay, I can cut this, and this, and still maintain the same level of manufacturing throughput or whatever it might be through your process to sell that same. So how do you lean the organization and make good choices without cutting things that might be detrimental?
Maybe some closing thoughts here, Megan. Anything that maybe you'd add to the conversation, and also what you would leave with businesses and those that are working in them, trying to manage audits and the like.
Sure. I would say going concern tends to get a really bad rap, but you don't want one, right? But doing that analysis is not a bad exercise. So, treat it with care. Really, cash is king. You want to look at that liquidity. Obviously, get help if you need. If you're lean, that's why Greg and his team are here too, to kind of consult and go through that. It's worth the spend. Sometimes you have to spend a little money to make a little money too. And that's the unfortunate truth. And especially during a downtime, that's hard. But I think it's really important to do that analysis, not only for your audit or your review, but for your business.
Greg, same question. What would you kind of close with and leave people with at this time?
Just building off of what Megan said, she made me think of something that a bank president had told us when we were helping with a cash flow webinar, was that they were requiring their companies to do these cash flow forecasts. And he said that what they found is that they got a little bit of pushback from the clients. They didn't have time or resources to do it, but they still had to do it nonetheless. And they wound up finding that they actually liked it, found it very helpful, very useful once they got through it and they understood it. I think having an open mind, being disciplined around data, using it to your advantage. It doesn't have to be the end all, and it doesn't have to be super exhaustive either. Use what you need to help give you that. I've been calling it that crystal ball. How do you make your visibility into what's going to happen a little bit more clear, and continue to build on it, integrate it into your the day-to-day, the month-to-month stuff that you're doing. Do a little bit out of it at a time, and just make a plan for what's next. So maybe that's rehashing a little bit of the goals of the ownership group, the management group, what's achievable, what's not, and then set incremental goals to get you there. Use it to focus the organization around what's happening. So as things continue to change, that's unpredictable, you can pivot rather quickly with them. So I think planning is a key, and I think that's what the data and what we have always done is really helping us do, is help plan for that that future, whether it's your next 6 months or your next year or maybe the next 2 years or 5 years, whatever it might be.
Megan and Greg covered a lot of ground today and mentioned some great resources along the way. You can learn more about them and find the links to the resources they mentioned in the show notes of this episode, which are available at bkd.com/simplytax. If you have questions or feedback on the episode, please drop us an email at simplytax@bkd.com or connect with me on social media. You can find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.